There are 5 concepts we need to learn in this chapter, and I'm going to walk through each of them with you. There are 5 simple equations that you can do to make these decisions about capital budgeting. The first one we're going to talk about is the annual rate of return. To do the annual rate of return, you're going to take your annual net income. You might want to underline that word annual. It doesn't always give you the annual net income. You might need to figure that out. And you're going to divide that by your average investment. This too you may have to figure out. To get your average investment, you're going to take your original investment plus that salvage value and remember your salvage value, also called your residual value, is what you expect to get back when you're done using your item. You're going to take all of that and divide this all by 2 to get that average investment. So let's walk through that example here. It shows us that we're going to have $40,000 of net income, but that's over the life of the asset. So the first thing we have to do is figure out how much our annual income is. Since this asset's useful life is 5 years, we just divide, and that will give us our annual net income over the life of this asset. Next, we have to find our average investment. It tells us the cost is $50,000. We have a residual value, which is the same as your salvage value, of $6,500. We're going to take all of that, divide by 2 to get our average investment, which is $28,250. Now I can go back to find my annual net, or my rate of return, my annual rate of return, because I have all of that information. And I take that annual net income of $8,000. I'm going to divide by my average investment to get that annual rate of return of 28%. They typically give you a minimum rate of return. Here that was 20%. As long as we are equal to or above, we would accept that project. Now let's take a minute and go through payback period. Our payback period is how long it takes to get your money back on an investment. There's a quick calculation to do this. It is your cost of investment divided by your net annual cash flow. Again, we're looking at annual, but the big thing to remember here is this is looking at cash flow. We're not talking about net income, we're talking about cash flow. So in this example, we have that amount of our initial investment, which is $100,000, but we have to find out what our annual cash flow is. It tells us we have revenues of $25,000. We have expenses of $17,000, which would give us a net income of $8,000. But this is my net income. I don't want my net income, I want my cash flow. So we have to consider our non-cash expenses like depreciation. And I will add that back in to get to the actual cash flow. So my net cash flow would be $13,000. So now that I have that number, I can go back to my original equation. I can take that cost of investment I can divide by my net cash flow to get to how many years it's going to take me to get my money back from this investment. Now, typically you can just weigh out and compare your choices and see which one you're going to get your money back fastest. If your annual cash flows are different amounts each year, then we just have to look and say, well, how many years is it going to take to get my money back? Let me give you a quick example. So if, again, my cost of investment was $100,000, but my cash flows are different each year. Let's say in year 1, I get $20,000. Year 2, I'm going to get $50,000. Year 3, I would get another, make it simple, and then year 4, another, we'll say, I'm trying to make it very simple here, we'll make it another $50,000. So what I'm going to do is just add up each year until I get to that $100,000. So I have 20 plus 50, 70, plus another 20 is 90. So I need 10 more $1,000 to make up that 100,000. So I'm going to take 3 years plus what this divides out to be. So that 10 divided by 50 is going to give me 1/5 or 0.2. So my total year payback would be 3.2. So that's your payback period. Again, if you have annual, you can do that quick equation. If they're equal, if they're not equal, you kind of have to go through each one. Now let's look at a more difficult topic, the net present value. Net present value uses tables to determine how much our money is worth today and what we should be investing in. To do a net present value, to find this net present value, we're going to take the amounts that are given and multiply them by a present value factor. For example, I'm going to take each of these years and the cash flow that's coming through each year. Again, I'm using cash flow in this one. 17,000. And because my cash flows are different each year, I'm going to use the present value of one table. The present value of one table shows you at one point in time I'm going to receive this money only one time, and what year I'm going to receive it, and I'm going to multiply that by my present value factor. To get that present value factor, you use your estimated useful life and that minimum rate of return that they're giving you. So they're giving you 4 years. I look down the left column, I find the 4, and I'm going to look over the top and find the 5. So I'm going to use those factors in the 4 years at 5% column to find my factors. In year 1, that factor is 0.9524. So I'm going from year 1 through year 4. In year 2, that factor is 0.9070. Year 3, that factor is 8638. And year 4, 0.8227. You'll notice all these factors are below 1. That's because we only receive this money one time, so that factor should be below 1. I'm just going to multiply these out, which I've already done to save some time. 4, 6, 8, 5. Hopefully I did these right. 12,000. And I'm rounding. That's fine. So that gives me a total of 66,028. This is what I will call my present value. Now notice I don't want to know my present value. I want to know my net present value. To get to the net present value, I'm going to subtract my investment amount. In this problem, my investment amount is $200,000. Your goal is to have a positive number here. We do not. Therefore, we would not accept this project. But this is how I get my net present value. Again, you want that to be positive. If it's positive or 0, you would accept that. That means you're making that minimum rate of return. So let's look at now how we use that to find our profitability index. To get to that profitability index, we're taking our present value. Now here, notice it's present value, not net present value. That's your present value of cash flows. And we're going to divide that by our initial investment. So for that problem we just did, our present value was 66,028. Our initial investment was 200,000, which gives me a profitability index of 0.33. This is just used to compare different alternatives. You want that number to be above 1 because that means you're making money. One last concept we want to talk about is our internal rate of return. For our internal rate of return, there's a quick equation, which is actually the same as your payback period if you have the same equal amounts. So you're going to take your initial investment, and you're going to divide that by your net annual cash flows. And this is going to give you your internal rate of return. We're going to use that internal rate of return to calculate how much our actual return is going to be. So for this example, my investment is $85,000. My cash flows are $15,000, which gives me an internal rate of return factor of 5.667. Now what I want to do with that, this is the first thing you're going to do, is find your factor. The second thing you want to do is look up that number of years that their useful life is on this present value of an annuity table. The present value of an annuity table, let me flip yours on the annuity. The present value of an annuity table is different from the present value of one table because this is considering how much that you're getting the same amount every year over the entire life of that asset. So you're getting the same amount each year. Here we assume that because we have net annual cash flows. So we're going to first find that factor. Second, look up the number of years on this present value of an annuity table. Then once we find that number of years, here it's 4, I'm going to just scroll across that column until I find a number that is, oh, it's not 4, is it? No, it's 10. So, looking at the wrong problem. I'm going to find that number 10, because that's the number of years. Scroll across that column until I find a number that is close to but does not go over that factor I just found. So if I do that, I can look at the number 10, kind of look through. I see 5.8892. That's too much. So I'm going to just move over one column. And then I'm going to find the factor on that table or close enough. And the last thing is look up that percentage. So where that factor falls, the percentage is 12%. And that would be my internal rate of return. Hopefully that helps get you through some of these problems. I'll walk through a couple homework problems with you as usual, and hopefully that'll get you